Most investors coming to Miami are fighting over the same deals and completely missing a strategy that's already changing the way top investors are positioning. What concerns me is not that they lose money. It's that many don't even realize where they're losing opportunity. Because if you're investing in this city, the real question is not whether Miami is a good market. The real question is, are you using the right strategy for the market Miami is today? And for many serious investors, that's where the disconnect begins. Stay with me. This may change the way you invest in Miami. Some investors arrive in Miami with only two strategies in mind. They either buy for appreciation or they buy for long-term rental income. Both strategies are valid, but neither reflects how Miami actually behaves today. Because here's the assumption almost everyone accepts without questioning it, that Miami should be approached like a traditional U.S. market. Buy, hold, rent long-term. Wait, and that's exactly why many investors feel stuck, even in a booming market. That logic works in cities where demand is stable and predictable. But Miami is not driven by a single type of demand. It's driven by movement, people coming in, people staying temporarily, people relocating before committing, executives on short assignments, entrepreneurs testing the city, international families creating optionality, business travelers who don't want permanence yet. And when too many investors chase the same long-term rental strategy, something predictable happens. Rents stop growing at the same pace. Competition increases, margins compress. At that point, investors usually blame the market or the property. But the property didn't fail. The market didn't fail. The strategy simply stopped matching how demand was evolving. In strong markets, that disconnect is subtle. In dynamic markets like Miami, it becomes expensive. Here, the real problem is not what you buy. The problem is that everyone is playing the same game at the same time with the same assumptions. Miami is not a typical U.S. real estate market. It's driven by migration, international capital, business travel, lifestyle decisions, and global events, all at the same time. Every year, a massive number of people come to Miami without knowing exactly how long they'll stay. Some come for business purposes. Others are escaping colder climates, looking for a better quality of life, more sunlight, and a year-round lifestyle that isn't available to them for most of the year. Some come to test the magic city before making long-term decisions. That combination creates a very different demand curve than most cities built mainly on permanent residents. In many cases, demand appears strong, but it's temporary, flexible, and constantly shifting. And that's where many investors get uncomfortable. What looks stable on paper is often flexible in real life. Traditional strategies are built around predictability, fixed tenants, long commitments, stable patterns. But what happens when demand doesn't behave like a straight line? When investors apply logic from New York, Chicago, or Boston to Miami, they often misposition themselves. Not because they made a bad purchase, but because they chose a strategy that assumes demand will behave the same way year after year. In Miami, that assumption breaks faster. After more than 30 years in real estate, one thing became very clear to me. Most investment mistakes in Miami don't happen at closing. They happen before the offer is even made. Mistakes happen when investors react emotionally to what's familiar, instead of aligning with the way this market actually works today. And Miami doesn't punish bad properties. It punishes rigid strategies. That's why I organize these ideas into a simple framework in my free guide, Miami's Pre-Construction Blueprint. It's not a pitch, it's a map you can use to understand how timing, demand, and strategy intersect in this market. But before I tell you how to access it, there's something important you need to understand. Because once this clicks, you don't just see Miami differently, you start questioning strategies you may have taken for granted. Because the missing piece is not the property, it's the model. And that takes us to the strategy many investors are still missing. Here's the part most investors don't see. While many are still debating appreciation versus long-term rent, a different group of investors has quietly adapted to how demand actually behaves in Miami. They're not guessing, they're observing. They see that Miami generates short, high-value demand windows over and over again. driven by events, business cycles, tourism, and relocation patterns. And instead of fighting volatility, they design around it. What separates these investors is not risk tolerance, it's structure. They understand that in markets like Miami, flexibility has economic value. So the question isn't does it work, it's where does it work cleanly. This isn't about renting more nights, it's about renting smarter nights. In many cases, a well-positioned short-term rental can outperform a long-term lease when the building, rules, and timing align. Not because of hype, but because of math. Higher nightly rates during peak demand, more flexibility, the ability to reset pricing, and the option to pivot as demand changes. But here's where most people get it wrong. This strategy is not about buying any unit and turning it into a short-term rental. It requires the right building, the right rules, and the right timing. When those elements align, the gap between investors who understand this model and those who don't keeps widening. This is the kind of shift where 6 months from now, people say, I wish I had understood this earlier. And if you're thinking that right now, don't. This isn't about having missed the opportunity. It's about understanding when the market creates the right conditions and being guided through them correctly. This channel is not about hype or shortcuts. It's about helping investors understand how Miami really works before they commit capital. Because strategies don't fail randomly. They fail when they're applied in the wrong context. And the painful part is this: you don't realize it until it's too late to fix. I've seen investors buy great properties in the wrong building with the wrong rules at the wrong moment. And none of that is obvious at first glance. That's why experience matters in markets like Miami. Not to predict the market, but to interpret it, to understand how demand behaves, how regulations shape outcomes, and how small details can change the entire performance of an investment. Throughout this series, I'm going to break this strategy down step by step, what it really is, what most investors misunderstand about it, and why structure, timing, and building selection matter far more than most people realize. Because once you understand the strategy, you stop chasing deals, and you start evaluating opportunities very differently. If you're investing in Miami or thinking about it, this is a conversation you don't want to miss. Because once you see this strategy clearly, you start evaluating every property very differently. In the next video, I'll explain what most investors get wrong about this model and why misunderstanding it can be far more expensive than they think. For those who would like to go deeper on these concepts, I created a free guide called Miami's Pre-Construction Blueprint. You'll find the link in the description. Or you can comment book below and you'll receive it. If you want to explore this more deeply, you can reach me directly through my website or request a private consultation session. I'm Guillermo Teran, and I help buyers and investors make smart, confident decisions in Miami's real estate market. Check out these other videos for more insights and visit my website to learn more about Miami's pre-construction opportunities. If you're ready to take the next step, we'll explore the most relevant options in Miami's pre-construction real estate market and find the project that fits your goals. Thank you for watching.